You buy a few houses, collect the rent, let someone else pay off your mortgages, and retire early. That is the standard internet pitch for building a rental property empire. To see how that actually plays out, we have to look at the baseline capital required to enter the market with a single mid-tier family home, priced around $200,000. This chart shows the true entry cost of that property. You are putting down 20%, that is $40,000. Add in closing costs, and you need another $10,000. Then, because things break the minute you close, you need a $5,000 emergency reserve. You are looking at a minimum of $55,000 in cash just to open the front door. Once you own it, the perceived monthly profit seems straightforward. You collect a realistic $1,600 a month in rent, and you pay about $1,085 in debt service on your loan. That leaves you with a gross margin of $515 a month. This specific calculation is where novice investors get stuck. It creates a false sense of security, making the property look like a cash-generating asset before the real math begins. That $515 gross margin is completely unprotected. It sits directly in the path of invisible operational expenses that immediately start attacking your returns. This breakdown illustrates the exact expenses attacking that margin. Property taxes easily carve out $200 a month. Non-primary landlord insurance takes another $125. You have to reserve at least $166 for maintenance. And since great properties still sit empty between tenants, you need an $80 vacancy allowance. As the chart dips into the red, your monthly cash flow hits negative $56. Annually, your starter property operates at a guaranteed $680 loss. You are paying out of pocket to own this investment. When that realization hits, new landlords panic. If a standard entry-level house functions as a liability rather than an asset, the entire premise of kicking back and retiring on monthly rent checks completely falls apart. The landlords who actually get rich know cash flow is only one fraction of the math. They evaluate deals using a core accounting concept called total return. While your bank account might be bleeding $50 a month, your tenant is paying down your mortgage principal. Every month, they are slowly converting your bank debt into direct owner equity. This diagram shows the other massive wealth builders offsetting that loss. You get compounding market appreciation, where the home's value steadily climbs over time, and aggressive IRS depreciation tax benefits that let you write off paper losses against your other income. These pillars easily dwarf the tiny negative cash flow at the bottom of the ledger. This projection shows what happens when you scale that math to a portfolio of 5 single-family homes. Over 10 years, an initial $250,000 cash investment balloons into $840,000 in total equity. True wealth generation in real estate is a slow-motion, highly leveraged equity play. It is not a monthly income stream. The catch is that you have to survive that 10-year waiting game. There is a massive financial difference between routine preventative maintenance and sudden capital expenditures. A burst pipe or a failed HVAC system will instantly destroy years of carefully planned reserves. Then you have the human element. Tenant turnover costs thousands in lost rent and cleaning fees. If a tenant stops paying, you face lengthy legal costs and months of carrying the mortgage with zero incoming revenue. But the ultimate portfolio killer is debt structure. If you combine maximum leverage with a sudden, unpredictable macroeconomic spike in interest rates, your variable debt payments double, crushing whatever tiny operating margin you had left. When investors cover those massive shortfalls with personal credit cards, their portfolios collapse. This exact sequence triggered the massive investor wipeouts of 2008 and caught thousands of over-leveraged operators off guard again in 2023. Surviving a full decade requires strict adherence to cash flow targets before you buy, and maintaining massive emergency cash reserves once you do. Professional operators bypass these small-time traps entirely. They rely on either extreme operational efficiency or massive institutional scale. The highly efficient route often starts with house hacking. You live in one unit of a duplex or fourplex while renting out the others. This unlocks owner-occupied financing rates, lowering your debt service and forcing the entry-level unit economics to work in your favor. On the other end of the spectrum, investors like Grant Cardone use institutional scale. Once a complex pushes past 100 units, a full-time in-house maintenance crew replaces expensive late-night contractor calls. Property management flips from a debilitating cost into a massive operational advantage. Some operators take a different risk by integrating short-term rentals. They trade high management intensity for double the gross revenue, offsetting the slow stagnation of long-term leases, provided local regulations don't ban them overnight. Real operators do not buy what is easily available. They manipulate scale or creative financing to completely dictate their own math. Between 2010 and 2019, investors in growing Sunbelt cities like Phoenix experienced a golden era. Prices doubled while interest rates stayed near zero. Today's reality is characterized by brutal carrying costs and 7 to 8% mortgage rates. The exact strategies that minted millionaire landlords 5 years ago, relying on high leverage and thin margins, will actively bankrupt new investors today. Modern real estate investment must be treated as a strict business, requiring conservative underwriting. You cannot treat property as a lottery ticket, praying for appreciation to cover your losses. The dream of a rental empire is absolutely real, but it is a 15-year disciplined wealth accumulation business, not a get-rich-quick scheme.